morning, everyone, and welcome to the webinar on banking in the new economic environment. The session today will have a presentation followed by Q&A session. I would request all members to use the Q&A tab for posting their questions. The session will be recorded and will be available on the YouTube channel of IBPC. The speaker today is Mr. Vikram Venkataraman, a very well-known name among the banking sector and our IBPC members. He heads the banking and financial services insurance focus group of IBPC. He is a veteran in the banking industry with over 2 decades of experience. His last assignment was with Mashreq Bank, where he was helping SMEs with the banking services. Presently, he is the managing director of Vianta Advisors DMCC. He appears very frequently, his editorials, his articles in the Gulf News. He is an alumni of Loyola College and Oxford University. And with that, it's over to Vikram sir now. Thank you.
Thank you, CB, and welcome to this webinar, everybody. I will be, it's a short presentation, 25 minutes or so. The presentation is real presentation is only 6 slides. It's a short presentation. Basically, I will talk about how COVID has affected banks and borrowers here. Borrowers, I think everybody knows. It's largely to do with banks, how they behave how they expected to behave going forward, how they've behaved so far, and what they will do later on this year, this period in 2021, and how some old habits may just come back amongst banks. So it's primarily about what the reading of the situation is, and also what should business do now, immediately, and in the near term. So this is what my presentation is about. My presentation. This is just a little bit about my company. We established 10 years ago. We work with SMEs and mid-sized corporates and sometimes large corporates to do financial advisory work. CB has already mentioned what I do. So let me get into the first slide, which is effectively on what is going on in the banks right now. Well, as you can imagine, it is chaos in the banks, and the banks are struggling with deferral requests from companies. It is also struggling with reporting to CB, central bank, and they are simply not equipped or designed to deal with this situation. I think nobody is, but the banks are no exception. So what is happening is they are now currently overwhelmed with deferral requests from all customers, from corporate customers, SME customers, retail customers, for mortgage payments, credit card payments, auto loans, for banking facilities, trade finance facilities, whatever, of all types. So there is no standardized approach that they have in handling this for the banks. The relationship managers are simply not equipped. So what they're doing is it's basically collection of information, and then everything is analyzed at senior levels, which leads to delays and struggles in the bank. I did a webinar a month ago, maybe, for RAC Bank's business banking customers, and there the managing director and head of business banking, Dheeraj Kunwar, said that they were flooded with 5,000 requests since inception. 5,000 requests. And so you can imagine just what the bank is going through. And I mentioned this because it's frustrating for all of us as borrowers when we put in requests to banks and nothing happens, there's no response. But this is just to tell you what is going on in the banks and how much they're also struggling. So right now, all the deferrals that they're giving, that is pushing all the current obligations out by 3 to 6 months based on the central bank guideline, is not really based on any cash flows or anything or any scientific methodology. A lot of it is best based on good faith and helping customers through this very trying time. So a lot of times the banks are unable to assess the difference between genuine and fake requests because both are flooding the banks now. So even people who don't really need the requests think that let's take advantage of the situation and conserve cash. Perhaps not altogether a bad strategy, because I think conserving cash right now is a priority amongst any company, whether it's an SME or a larger company. So this all aligned with government directives right now, and banks are also interested in keeping clients in survival mode. So there is a difference between what the current world and the post-deferral world, which I define as when basically all these deferrals of obligations get over. So that's basically the difference. So the thinking of banks and the reasons for current actions need to be very clearly understood, because people think that it is the central bank is putting money into the hands of SMEs, or giving some sort of leeway to banks in terms of provisioning or anything like that. But this has only to do with liquidity from the central bank point of view. It has nothing to do with subsidizing any of the risks that the banks are taking, or to manage any provisioning for them this year. The only thing that makes a difference is that the central bank has given banks leeway as to the incremental provisions made this year over last year, which will not be taken into account for capital adequacy calculations by the regulator for 5 years till 2024. That's all. So basically that means the banks still have to take provisions. It has to pass through their P&L. They will take a nasty hit this year, and the rating agencies will take their view accordingly. You've seen, some of you, 4 banks' ratings have already been downgraded this year. So what happens when this deferral period ceases or is completed? So post-deferral is it's a post-lockdown, not really post-COVID. So what the banks have already started doing, they've started looking and worrying about what will happen beyond, because suddenly in August, September, July, August, September, whenever people's 3 months or 60 days or 120 days or 180 days is over, what happens to them? So they've started analyzing their portfolios and categorizing, firstly, industries which are maximum affected by COVID. So obviously all the industries which have maximum social interaction, i.e. Travel, airlines, F&B, hotels, all this sort of thing, will be in those categories. And within those categories and industries, they categorize the strong to weak clients. So these exercises have already begun amongst banks, because they know what's going to happen in August, September onwards, when there will be an avalanche of failures, as well as restructuring requests, failures with people also absconding. At least that's my reading. So they've already started working. What they're going to do, how they're going to respond, I don't think they even have an idea themselves, but at least they're preparing to the extent possible. So the banks, basically on the lending side, what's happened is it's a total freeze. So they're not hardly lending. And unfortunately, even things like third port trading, which is trading to other ports other than the UAE, which should actually be seen in a positive light, is still on hold now. As far as the restructuring, what I expect in September, October, the banks are willing to be flexible and restructure, but things have changed now. They will expect a lot more. The main thing is there are great expectations on going forward, on transparency, on corporate governance, which I'll touch on in a later slide, and open information and honest information from borrowers coming through, unlike may have been the case always in the past. Meanwhile, just a little summary of what is actually going on at the banks. Top lines are collapsing. You've seen the results of a few banks coming out in the first quarter. So if they're not writing new business and all loans are being paid off, so your revenues will collapse and start falling. Liquidity was thinning, and that's why the central bank came in. So liquidity, a lot of it went out. A lot of deposits went out. Money market and overseas lines from banks have been cancelled to each other. It's not peculiar to the UAE. So that a money market line, for example, to Bank ABC in Dubai by 7 international banks would have been slashed by 50% or whatever, depending on their rating. Provisions are skyrocketing, and it's going to be much more in the last quarter this year. So they're going to take a lot more both write-offs and provisions this year. Central bank has come to the rescue, but it's a liquidity play. And there's some capital relief, as I mentioned earlier, but there's no profit subsidies. It's not like the losses that the banks will take will in any way be subsidized by the government or by the central bank, which translates into there's no money directly being put, one-way money, into the pockets of businessmen or business owners. So what do companies need to do? You need to, if you're a company, if you're a corporate and you're a borrower, or if you're advising clients, you need to think of what you need to do and think beyond you need to start thinking beyond the deferral world. So the COVID disease is not disappearing in a hurry, and for your own survival and to retain the confidence of banks, banks expect you to have thought of what is going to happen to your company or to your clients. What is going to happen beyond the short-term impact? What exactly is the short-term impact? And what is the long-term impact? And what is your plan? So what I tell my clients is at least do some stress testing over some time buckets. So 3 months, 6 months, 1 year, 2 years, as to how your current business model is going to withstand the effects of COVID and what you're going to do to survive in this time. Now that may mean reinvention, it may change, it may mean alteration of business models, it may mean change of business models, it may mean shutting current businesses and starting new ones, it may mean a completely different avenue that you may wish to pursue. But the stress test, banks would like to see this insofar only as at least one businessman has told me, or a couple of businessmen have told me they've done a 2 years stress testing exercise to see exactly where they stand. Do they have enough equity, business model, appropriate business model in place, and all the resources to reinvent and to rejig themselves to survive and to in fact grow. So this is what even some big retailers and big businessmen have told me, that they work towards a new normal. Say 2 years from now, this will be my turnover, and then they're working backwards on a plan, and they're taking actions now. So when you read articles, McKinsey articles or Harvard Business Review articles or any new international newspapers, you'll find a lot of the large companies have done this. And there's no reason why this is restricted to large companies. Everybody should start thinking differently. This normal trading mentality of buy today and sell tomorrow and juggle finances, that's all gone. Now it's going to be history now. So we need to be a little more professional and strategic in our thinking and planning. This is going to come and settle on everybody as an obligation going forward. So if you are in trouble, if the companies are in trouble or your clients are in trouble and you need to restructure, and you know in September, October, you will not be able to pay obligations going forward because your business has collapsed, you should start working on your restructuring plan for your remaining obligations now, and not wait till October, because what's going to happen is then at that time there'll be dozens and hundreds of companies coming in with restructuring proposals to banks of all shapes, sizes, and quality. So you're going to have very well prepared plans coming in. You will have complete, absolute rubbishy plans also being submitted to the bank because of complete ignorance on the part of the business owner or the CFO or the accountant, not even CFO, mostly in most companies that I observe. So what are banks going to do? It's not a question of yourself, right? It's a question of yourself in comparison to the others. So if a bank RM gets 10 proposals on his table, and out of them 2 stand out because they're well structured, they're well written, they're thought through, and they seem honest. Guess which ones are going to be paid attention to first? So you're going to be competing even for the bank's share of mind. So start preparing for this plan now. This is a very good opportunity if you're carrying baggage on your balance sheet, skeletons in the cupboard, dirty linen, put away, holes in your balance sheet which you've been covering up all these days and months and years. This is a very good time to wash all that out, take losses in the balance sheet, because this is a good window of opportunity which you can use, and banks will be willing to look at losses in a slightly better and more lenient, or sympathetic light than they were before. You should also start making serious plans for deleveraging your company, and you should address stakeholder support. And this means that I think the thinking has to change amongst business owners about hanging on to 100% of equity in these times. If you have a hole and if you need to address it, you need equity support, and you have a business model that is sustainable and indeed profitable over the next 3 to 5 years, you need to think of bringing in outside equity partners, because those days of just hanging on to equity and thinking that you'll have everything to yourself, I think will soon come to an end. So for the bank, you need to list your immediate steps, quantify them, and present a coherent plan to lenders. If you want share of mind and eyeballs on your plan, because you will be competing for their attention, believe me, from September or October. So then I divide it into phase 2. And this is something new. So far, borrowing from banks has been transactional, which I've observed over the years in my 26 years here. In the sense, it's transactional. There's no plan of borrowing and funding and constructing your balance sheet over time in a respectable and in a predictable way. So it's like take the limits that you get, bumble along, stumble along, and grow. This is not going to work now. So I think you need to have a proper financing and borrowing strategy. So far, it's been purely transactional, as I said. So because that was due to the easy availability of bank funding, so one could afford to be like that. Not anymore. Banks are not going to lend for a while. So this laziness that has been bred by because of the environment, because of surplus liquidity and credit availability, is now ended, I think. So now, planning has to be beyond this. Planning has to be behind the future or growth of your company. More strategic thinking on finance, not transactional, has to be the new approach. So it's a question of how you view debt and leverage over time, now and over time. I think the world is over leveraged. The world is now, all the ones who are over leveraged and had debt are collapsing first. And the companies, which I've seen both types here, my clients who have very low leverage, perfectly fine, happy. They have borrowings, but they're not over leveraged. So it's your own attitude towards borrowings and leverage needs to change from now on, because easy availability of bank credit is a thing of the past. You need to think of your funding profile as well of your company, how much from suppliers, how much insurance backed, how much from lenders, and indeed how much from equity. So this is what I talk about, funding diversity. The other thing I've noticed over the years is that people put all kinds of stuff onto their balance sheets, personal properties, official properties, investment properties. You have to realize now that banks like to fund operating companies, i.e. opcos. Your balance sheet should not become a holding company, i.e. holdco, which I've mentioned on the slide. Funds are not fungible. I mean, they've tolerated it so far, but going forward, they will want to strip out, holding company kind of an approach from the operating company. They will want to see and ring fence funding to operating companies. You need to reset your thinking a lot more, because now everybody is going to focus on risk management. I'm advising a client now, when we looked at the business model profile, we found 75% of purchases was from one supplier, and nearly 60 to 70% of sales was to one country. So my first piece of advice was, let's please start acting aggressively to reduce these kind of dependencies. So this is part of risk management. So succession planning, key man risk, your processes, IT, all these things, however small we are, we need to start thinking along these lines. Okay, for the larger people, so far it was bullying, playing one bank against the other. These were the strategies, transactional basis. These days will go, so please be transparent. One has to negotiate going forward, not bully banks. This is a theme that keeps recurring in my conversations with bankers. Owner commitment, which means they now expect people to put money on the table, reach into personal pockets or cousins, family, whatever, and put in more equity. This is a recurring theme. So even when restructuring happens, they will say, what are you bringing to the table? If you say nothing, then the chances of getting a reasonable restructuring to help you out fall. Okay, so then there's something about the future. So this is going forward, a little bit to think of your own company's survival. You need to think very carefully about the future. and do some strategic planning for yourself over the next 2 to 3 years. So some people should get together in your own company, 2 or 3 people, to think very long and hard about the future business model. How will it come back? How do you respond? What do you need to respond to? Because thinking that things will improve is not a strategy. Hope is not a strategy. Hope is hope. Strategy is realistic understanding of realities, a worst case analysis, a best case analysis, and those sort of things. So there has to be structure to this. Banks are not going to tell you a lot of these things, which I'm mentioning on the slide, because it depends on the individual RM's capabilities and sophistication. So I'm not very hopeful that they'll come and tell you all these things. But they will certainly expect an intelligent process to be followed about, and certainly look at the outcome of that process. And again, you are thinking about this not just for yourself, for your company, but also to be showing, to demonstrate to the banks that you are superior to the others, that you are thinking of the future, and the next guy is not. So guess who's going to get the money? So you have to question your home markets right now. If you're dependent on one market, you really have to question your home markets and your clients. New markets and business models have to be examined very closely. I've had several customers of mine which are focusing on different things. To myself, at a small level, my own company, we do several things. We do due diligence work for banks. We do fundraising for companies. We do a lot of advisory work. But I'm now focusing more on advising and working with stressed companies to help them. So it's a little bit of a change in what I do. It's not a remarkably or drastically changed business model, but the focus has shifted. So in your business, maybe it requires a focus shift, maybe it requires a model shift. I don't know. So the next thing is the governance, and these requirements are not yet legalized. I mean, there's no company law here. There's no SEBI, there's no SEC or anything of the kind which governs. But I think banks with varying levels of sophistication will insist on corporate governance in companies. You also need to think about pricing your own risk. Banks are not very good at pricing the risk of the business. They just price their own loans to you, and that's very often competition driven rather than anything sophisticated. So you have to decide whether your capital at risk is worth the margins. If you're operating with a gross margin of 3% in a highly volatile business, you really need to question. If you come up with the answer that that's all I know, I don't know anything else, that's not the solution now. You've got to realistically price your own risk. I've touched on this. Corporate structures, a small SME of 20 million, 30 million, or 15 million of turnover can't have sophisticated structures. But certainly banks are looking for some sort of checks and balances in your company. And I think that if you demonstrate to them that it's not a complete one-man show, then again, chances of leniency, chances of sympathy, and again, I go back to chances of your proposal being looked at ahead of others improves dramatically. So this is for the larger ones, an independent board with authority. It's not legal, but already I have my larger clients talking to me about setting up boards, about bringing in people with experience in various streams of business and life to advise owners. So this is already starting, I see, just in the last 1 month. But I think this is going to be very, very important. Even if you're a 20 million dirham company, you need not have something as fancy as a board, but have some advisor, another consultant, or have a mentor, somebody to bounce everything off, who will give you, who will be a good sounding board and give you a contrarian view and not be a yes man. So I think with that, I think that's my last slide. My wrap up is basically this, that everything has changed with COVID. The bank's thinking will change. It's going to be a long while before we come back to anything resembling normalcy as far as lending is concerned. The avenues for lending, borrowing for SMEs will be even more restricted than they were. So I think one has to stand above the rest and be seen and be heard. And for that, a professional approach is required, not volume of the requests that you make. Thank you, and open to questions, please. Okay, so Kapila. Hi Kapila, how are you? It's been a long time. Kapila's question from Abu Dhabi is, shouldn't bankers too change their hats as when they start funding a client, they become a partner of that business, which is beyond lender-borrower relationships, whereby attitudes need to change in holding hands in challenging times. Absolutely, couldn't agree more. Couldn't agree more. But look at it from the bank's point of view right now. Let's be practical. Banks are going to try and protect their loans. They're going to try and protect their minimize provisions. And indeed, the average guy out on the banks, the RM is going to be more interested in protecting his job, because jobs are going. Jobs are shrinking. The number of banks are shrinking. So whilst, yes, this partnership is there, it will be tainted by this survival instinct, both of the bank at an institutional level and the RM at a personal level. So, every man for himself is, unfortunately. Therefore, the onus is on the borrowers to do a lot more. Theoretically, you're right. Rajesh Agarwal, how about new vision by banks for lending to SME and mid-market corporate sector? Well, the depressing thing from what I'm hearing from banks, there is no new vision. There is going to be no new vision. They're frozen in their lending right now. They're concentrating on protecting their book. Very, very selective in lending, and this will continue for a while. So I don't think we can expect anything dramatic. That's the sad but realistic answer. Mayank Tiwari, is it possible for banks to put more equity? I'm not sure equity where, into themselves or into SMEs. I don't know, so I don't understand that question fully. So I'll move on. Vivek Agarwala, given the difficulty in loan by banks, do you expect surge in financing from other sources at higher costs? Well, one should expect that, because if you have cost of credit and cost of funding going up, you expect new lenders to come in attracted by these things. So I've been talking to people overseas, funds overseas banks, etc. Maybe this will happen over time, but right now, no one's coming into this market or going anywhere because of the fear of the impact. We still don't know the full fallout. As I said, it's later on this year, over the next 6 months, the true fallout of COVID on enterprises in the UAE will be seen. So Mayank, as we're expecting from other business to put more equity, so the same approach can be expected from banks. So again, I presume now you're talking about equity into the banks. Yes, that's really not our concern, because it's a central bank regulation, regulatory concern. They will need to bring in more equity. I think ENBD has already done that. So that will happen. If the necessity arises, that will happen for sure. Atul Agrawal, if the banks withdraw the facilities abruptly just for the reason that the specific sector has been put on watch list, what can the borrower do? Yes, so this has been going on for a while now. This is not new. In fact, if anything, this is going to reduce, not increase. But this has been going on since 2015, since oil price started crashing. So what the borrower can do is not panic. And I've seen even large borrowers panic, get scared because of the bank's language and the approach that they might take, and rush in and agree things that need not have been agreed. So what the borrower can do is to either seek professional help in handling these banks, or if they are fully capable, is to take a calm approach and give them a proposal to exit or whatever it is over time, in a respectable period of time, giving them reasons why they should wait. That's all you can do. There's nothing else you can do. Plus, look at things of way to mitigate the risk. Perhaps look at insurance markets for a variety of reasons. Look at supplier credits for a variety of reasons. Various other things which can be done. So, but if you don't have the wherewithal to do this, then I think you need to, seek outside professional help. Yes, Rajesh, But the government of the UAE is telling us for the development of industry. Absolutely right. They've been saying it for years. They are doing what they can. I mean, what else can they do? They can't put money in our pockets. They can't put money in any businessman's pockets. They don't, I mean, everybody, all the governments don't have the money. So in UAE, in the UK, for example, people are giving grants, furloughs, paying salaries, etc. But remember, that's for domestic populations, for citizens, etc. Here we are all expatriates. So even if the government, say, pays your company's salary for 3 months or 4 months or 5 months, what's the guarantee you're going to be here? You might collect all your receivables, sell your stocks, and disappear at the end of 6 months. There's no guarantee. So if you look at it from the government's point of view, doing subsidies here is an impossibility. They can only help to the extent that they're helping now, I think. James Matthew, in India, there is a clear definition of MSME. The MSME, they're giving stimulus packages. Here we don't have any definition, no special consideration for SMEs. Can the system be changed to have preferential payments to SMEs? Of course, clear definition, etc. 30 days strict credit for SMEs, more SME funds. So basically preferential treatment for SMEs. Yes, in fact, in several of my Gulf News articles, I have written the same thing, that in fact, I've written that government should first instruct the government departments themselves to release payments to SMEs in time, in the contracted time, not delay even beyond the contracted time. So this is absolutely right, and this has been suggested to the central bank, suggested to the government, but translation into action seems to be very, very slow on this front. Ram Narayan, banks are giving just 25 days notice and shutting down accounts, even non-borrowing accounts in some sectors like general trading. Who will support for the transactions? Yes. I mean, I don't have an answer, but that's why one must never have 1 or 2 bank accounts. Be circumspect and have at least 2 or 3, depending on your company's size, to mitigate the risk. Perhaps have an account overseas and keep online accounts open. And this is what I meant by risk management, you see, earlier on. So I'm saying this is the kind of thing that people should pay attention to. So not have any dependence on 1 or 2 borrowers or say lenders, or even of non-lending relationships. It's related to India, the ongoing case in the Supreme Court with banks for interest waiver during the COVID period. What's your opinion about the outcome? I have no idea what the Supreme Court, or which way the thinking is going on that. So sorry, I don't have an answer on that. Ravi Chitnis, should businesses who have no banking facilities yet expect? If you're saying expect banking facilities, if you have a very, very strong business case, a business model that is at least partly or substantially COVID-proof, it's possible, but beware, banks are expecting tangible security also to be thrown into the pot, actual collateral, not like just pure balance sheet lending. Eugene D'Souza, with the global interest rates reducing, will this trend catch on in the UAE as well? When the Fed increased the rates, of course, we saw an increase here, but the corresponding decrease has not been seen. Well, people have to push back with banks to get them to reduce. Yes, it's difficult. Banks will resist this because they're going to be hit with so much of loss right now. So this is an easy way to make money. So if there's pushback from the borrowers, yes, but otherwise they're not going to pass it on very voluntarily. That I don't expect that. Arvind Akshan has asked a question about credit insurance. Any suggestion about credit insurance, which was difficult even prior to Corona time, and of course will become more stringent now? Well, hypothecation of stock is a viable security option. Well, to answer, the credit insurance is not going to get easier. Insurance are also, companies are also lenders like banks in a manner of speaking. So they have the same credit criteria. So it's going to be difficult, but I've also written an article again, and I'm hearing from my friends at Etihad Credit Insurance. They are trying to step into the breach and trying to do domestic receivables insurance as well, which they were not doing before. So that is the good news on the insurance side. Stock hypothecation is an old story, but if you're talking about a collateral management agency, a kind of an arrangement, it might work, although it's not taken off here. It's certainly a viable security option, but it's not been practicable here so far. And I personally have tried it with banks. It's not worked so far. But maybe going forward, I think they might be much more open to this because it's a secured form of lending. And how receptive do you think banks will be to accept disclosure about old issues and holes in their balance sheet when discussing restructuring? Yes, this was my point exactly, about washing dirty linen. Again, Anand, it depends. It depends on just how the proportion and the size of the bad news in relation to your balance sheet and the bank's exposure, and also how you present it to the bank, and also how you present mitigating factors to the bank. Just dumping a load of bad news on their tables is not going to help. So it's a question of structuring the response with coherent reasons why you have old issues and holes, and then what you're doing about it. So we've done restructuring proposals where we've used opportunities of collapses and problems in other countries to surface all old baggage, and tell banks, and then build a plan according to the proposed new cash flows and business models as to how those holes will be covered up. So it is possible, but how you do it and the extent of it needs to be carefully done. I would say this is an area where you need to actually take help or go and talk to some people to see how you can present this to banks. But yes, it's a good opportunity. It's a good opportunity. They will be receptive and they will be grateful for it right now because it's a good opportunity. So I think I've already made my conclusions and summary. The situation is not looking really great for borrowers. And for existing borrowers, I would say the focus should be on preserving and keeping bank lines. And for those who are restructuring or feel the need for restructuring, you should get the most lenient terms possible and think very aggressively about the future and in formulating new business plans and new alternative sources of funding and indeed risk management like you've never done before. The times are going to be very tough. The sources of debt are going to be scarce. The sources of equity are going to be scarce. So I think a lot more needs to be introspective. You have to look inwards a lot more than just merely looking outward to the government and to the banks for help. Because I think both have gone as far as they have. And the government is more focused on bringing people back in and bringing confidence back in and for reinvention as a country. They've got other bigger issues to deal with. And this COVID hasn't helped. So they've got the health issues, which they've done a remarkable job in handling as well. So I think that now it's really up to us as business to look inwards and to justify our existence here in the UAE and justify the existence of businesses and justify the lending that banks are doing to you. Thank you very much indeed.
Thank you, Vikram sir, for sharing your analysis of the current scenario and how we can navigate through this. Thank you so much. Our special thanks to our platinum sponsors, Lulu Group International, District 1, Mohammed bin Rashid Al Maktoum City, Bank of Baroda. And members can always write into us at queries@ibpcdubai.com. This presentation will be shared with our monthly newsletter, IBPC Bulletin. Thank you so much.